Good morning, everybody. It's May 6th, Monday, May 6th, and here we are again having our conversation about what happened last week, what's happening this coming week, and through the end of this year, through the decade, and to infinity and beyond. Lots to talk about. For those of you that are wondering, yes, Max is a reliable dog. He's reliably here, so that's a good thing, and he's also reliably snoozing. By the way, he may not look like it, but Max is a bulldog. He's a little bit more bullish than he had been on the market. Anyways, that's something to factor in our thought process. But of course, there's more good fundamental reasons why the market seems to be doing better. I guess there's nothing to fear, but nothing to fear. I mean, the only thing we have to worry about is that fewer people are worried. We have seen the bull-bear ratios for AAII and for investors' intelligence. Both of those have come down. So people are a little bit less bullish, kind of in line with kind of the average reading for those bull-bear ratios in the past. They're no longer well above those indexes. So sentiment, maybe everybody's watching the sentiment indexes and they can change their minds pretty quickly. So we've seen that come down. I think more importantly, of course, is the price of oil's come down. It had been something like at the beginning of April around $91 a barrel, $92 a barrel, and now we're well below that. We'll look at that in a minute. But that suggests that the risk premium, the geopolitical risk premium in oil has come down. Of course, it's not as though everything is just wonderful now on the geopolitical front. There's still an ugly war going on between Russia and Ukraine, and the Middle East situation is still extremely volatile, where now it looks as though the Israelis might go into Rafah, and so that situation is not over. But the price of oil has come down, suggesting that oil traders believe that whatever happens in these two geopolitical hotspots, there's still plenty of oil around. And in addition, global oil demand may be relatively weak along with the global economy. Global economy is not in a recession, but it's muddling along. The U.S. economy is doing well. Looks like the European economies, as Melissa and I reviewed last week, looks like the Eurozone economy has bottomed from its mild recession in the second half of last year. Looks like it's doing somewhat better. It's not up in a way, but at least it's not declining. China's economy is sort of a mixed bag. Property market is still depressed, of course. It's a long-term issue. The underlying demography is a negative for Chinese consumers. The big negative wealth effect from real estate prices being down and from the stock market being down, those are clearly weighing on consumer spending. But they're doing the same old approach to stimulating their economy. They're manufacturing a lot and they're exporting a lot to the global economy, and they're also exporting deflation because in many ways they're dumping goods into global markets in an effort to keep their economy afloat. So that's where everything is, and I think we're seeing that in the price of oil. With regards to the Fed, it's been a wild week last week. When the week started out, we had some wage inflation indicators that were somewhat worrisome to those who worry about inflation being persistent and going higher. That's not our case. Our view is that inflation is still very much moderating, and we'll get down to 2.5% by year end. So we're still encouraged in that regard. But the financial market seemed to go from okay, the Fed's not going to be lowering interest rates at all when the 2-year got to 5% early last week. So that implied maybe one rate cut. So they hadn't completely given up on rate cuts. And remember, that's over the next 12 months. So now we're looking beyond this year. We're looking into the first few months of next year. So at the beginning of this last week, the perception was, well, maybe the Fed's not going to raise, not going to be lowering interest rates. Maybe they're going to possibly be raising interest rates. And then by the end of the week, when we had the really calm payroll numbers, the market swung around to, well, maybe we're going to have two cuts after all, because the perception was that wage inflation is coming down and the overall employment number was okay, but it wasn't gangbusters, and maybe the labor market's slowing down. So that got the stock market excited again. So what do we have to worry about? We still have to worry about the geopolitical situation. Now, I suppose some of the stagflationists and hardcore hardliners got something to get them excited about last week. Slower economy, and if they look at some of the numbers last week, they could say that inflation is still a problem. But that's not our story. Let's look at some charts here for our story. Our story is same as before, 60% odds that we're in something like the roaring 2020s, where interest rates have peaked. Interest rates can stay at these levels. They have normalized. We don't have to worry that the Fed has to lower interest rates in order to revive the economy. By the way, I guess one of the things that has come back at the end of last week, see how long it hangs around, is the Fed put. Because if the labor market's slowing and if wage inflation's coming down and inflation's coming down, then the Fed surely will move to lower interest rates if that's really necessary, because the economy is slowing significantly. So that significantly reduces the likelihood of a recession if push comes to shove on the economy. So we're back into Fed with the Fed put out there. But in the roaring 2020s, I don't need all that to go to make things wonderful. Just all I need is productivity continue to do well. It didn't do well in the first quarter. I think that's quarter to quarter volatility. I think it is very volatile quarter to quarter. We look at it on a much more smooth basis. Last year was a very good year for productivity. We think this will be a good year for productivity as well. And productivity is what allows real wages to grow, inflation to moderate, profits to remain strong, the economy to grow better than expected. So we still think that's the roaring 2020 scenario. Put that at 60%. Another scenario is the repeat of the 1990s, especially the tail end, where we have a melt up in the stock market. Now I'm back to thinking that that's another possibility here. If people start to conclude that we've got the Fed put back and earnings are doing fine, so why not keep the party going, party like it's 1999? So that would give 20%. So 20% plus 60%, 80%, that things are pretty good. 20% of that is maybe things are too good, but we're not there yet. We'll talk about that along the way, see how it unfolds. And then 20% for the great inflation of the 1970s, a repeat of that. And a few days ago, a couple of weeks ago, that was a concern, more of a concern than it is now. I didn't change my probabilities. I'm not that flighty about these things, but I was talking about the geopolitical risks, and they seem to have evaporated here pretty quickly. So now I'm looking at the 1990s risk, and meanwhile, I'm still pushing the idea of the roaring 2020s. So let's look at the data here that convinces us, our team. And by the way, Eric Wallerstein formerly of the Wall Street Journal, has agreed to join us. So he'll be joining our team on May 7th. We're very excited about Eric joining us. He graduated from Bucknell in economics. He's got a great work experience at the Federal Reserve Bank of New York on the money market desk. And he's been at the Wall Street Journal writing front cover stories on a fairly regular basis on various subjects that I think you'll find very interesting. And like me, he's interested in everything that matters to our business, which covers a lot of territory. But I think you'll find that he'll round off our team really well. as did my son David Yardeni, who joined us a couple of weeks ago. I think I mentioned to you he was actually doing an internship and focusing on the new database system that we have, and he's become a real Jedi master at dealing with that database, and you'll see more of his work. And meanwhile, there's all the rest of the team. I don't want to leave anybody else out. Jackie does great work. Debbie, Molly, Joe. Anyways, that's we'll maybe do a little Brady Bunch program here where we'll all get on and look at our team and what we do for a living. But you know what we do, and so let's stop with the chatter and go to the meat of the program here, which is to look at the charts. A chart collection for morning briefing. The title of the piece today is "Almost Everything's Coming Up Roses." At least it seemed to be at the end of last week. So let's take a quick tour of what's new here. Well, we've seen the fixed income markets change their views pretty rapidly last week from maybe there's at most one rate cut to now maybe we're going to get two rate cuts after all, maybe three. The 2-year was above 5% at the beginning of last week, and then as you can see here, it finished up at 4.881%. I got my other glasses on here. So we view the 2-year as a good predictor or a good market indicator of what the markets think, the Fed funds rate will be in a year from now. And we could also look at the 12-month forward Fed funds rate. And so again, the markets are back into thinking that rate cuts are not off the table. And again, we're looking at 12 months ahead, so we're no longer just talking about 2024. I'm not going to dismiss the possibility of rate cuts early next year, but I'm still not convinced that the economy needs or that the Fed will, in fact, lower the Fed funds rate this year. I got no problems with that, but I don't think the economy is going to be disappointing enough to convince the Fed they have to do that. So meanwhile, again, at the beginning of last week, I and others were talking about next stop is 5% on the 10-year. And by the end of the week, we're saying, well, maybe now that we're back to 4.5%, maybe we're going to see if there's any support at the or resistance, I guess, when you think about what we want to happen. Obviously, people who own bonds want the bond yield to fall. So the question is, will that yield find resistance at 4.25%? Again, I'm inclined to think that interest rates, especially the bond yield, is normalized, and this kind of level of call it 4 to 5% is normal, and that the economy can handle it, and it's a reflection of the strength of the economy, the resilience of the economy. Stock market did its little loop-to-loop last week. We had some up days, some down days. We've been all over the place, but haven't really moved much. We're still below the 50-day moving average. Perhaps today we'll cross back above it. This was an interesting chart because for a while there it looked like up and away. You know, I had a channel drawn here, and there was a possibility that this would be going up towards 100 as the geopolitical situation worsened. And the geopolitical situation did worsen with Iran lobbing 300 missiles, drones, and other aerial weapons at Israel, and then Israel retaliating with an attack of its own. And all of a sudden, things are a little quieter, at least between Iran and Israel. Up in the northern border, there's still a potential for a breakout of war between Hezbollah and Israel. And of course, the Hamas situation is still very much an issue with regards to Rafah and what Israel's incursion into Rafah might do in terms of responses around the world. So that geopolitical risk is there, but you're not seeing it in the price of oil. And for what concerns us in terms of our daily professional business, this moved back down is telling, and it does suggest that the markets believe that there's plenty of oil around, demand's kind of weak, and there's no reason to be concerned that the geopolitical crises are going to be a problem. Markets know all when they do, and we'll see if that's the case. With regards to the payroll employment numbers, they look pretty good at first blush. A lot of people describe the employment numbers as Goldilocks. They were actually on the weak side. One of the reasons they were on the weak side is because average weekly hours declined. But as you can see, you need a neck brace to watch this series. It just kind of goes up and down, up and down. So I'm not quite sure that this means much of anything, but it does have an impact on this number, which is aggregate weekly hours of total private industries. So you take the weekly hours put in, and then the number of people working those weekly hours, and you get total weekly hours. And you can see that's still very much on an upward trend. It also got some zigzags into it. So I guess after it zagged, it'll zig next month. But that'll have an impact, presumably, on April's retail sales number. You can see that our earned income proxy, which is looks at aggregate hours and multiplies them by average hourly earnings by wages. That number, if you could take a magnifying glass here, you can see that was actually flat. And our earned income proxy is not surprisingly a very, very highly correlated and good indicator of wages and salaries and personal income in the private sector. And so this is probably going to be flat. And so if it was a kind of a flattish month for personal income, wages and salaries anyways, then it's likely to be a relatively flat month for retail sales. And that's the next chart. Before I get to that chart, there's this chart which shows that average hourly earnings adjusted for inflation remain on this uptrend they've been in since 1995, though again in April looks like they might actually be down a bit, but the trend is still our friend in terms of the real purchasing power of consumers' wages. Let me what the whistle here. So this is just a bunch of colorful colorful series. You can look at it on your own, but the earned income proxy's in there and it's flat. This is all in current dollars, and it just shows its various correlations with what people spend their money on, basically retail sales, core retail sales, personal consumption expenditure of goods. So it's all focuses on goods. Retail sales obviously is merchandise. So it could be a weakish number. So could industrial production for April. We get aggregate hours worked in manufacturing for April, and that was relatively flattish. And so there's not much signs that industrial production is suddenly up and away. But so this all means that the index of coincident economic indicators for April might be flat, might actually be down a little bit. So April is not a strong month, but it's not the beginning of a recession. It's not the beginning of a major slowdown, in our opinion. Meanwhile, the Citigroup Economic Surprise Index, which you also need a neck brace to keep track of, now because of the weaker than expected indicators we've had last week and the past couple of weeks, that's come down rather sharply. It's now below zero. This is actually a very good indicator for what the bond yield should be doing, and it's highly correlated with the bond yield. The bond yields come down, reflecting this weakness in the indicators relative to expectations. Again, in your free time, if you have time, take a look at this chart, and there's some correlation, not a perfect correlation, but generally speaking, when the CESI, the Citigroup Economic Surprise Index, is weak, the bond yield tends to come down on a 13-week basis. It'd be kind of nice if we had it, if it was a great leading indicator, but it's really coincidence. So by the time you see the bond yield coming down, that's when you go and look at this chart and say, I wonder if that supports it. And sure enough, it's supporting it. U.S. Purchasing Managers Indexes, they were contributed to the weakness in the city group economic surprise index. The manufacturing index, which is the red one, dipped back down below 50. That's not a surprise to us. We were pointing out that the regional surveys were suggesting that we're still not up and away on the PMIs for manufacturing. It does look like we've bottomed in any event. So maybe things are getting somewhat better, but it's not a boom in the goods sector. Meanwhile, this was puzzling and somewhat disturbing because this economy has been getting a good boost from baby boomers spending on services. And so this services index fell below 40. When I see data that doesn't support my story, as I've told you before, there's either something wrong with the data or it's going to be revised to show that I was right after all. But seriously, folks, let's look at a couple of indicators here of the PMIs. Again, this is the regional average of the regional PMIs, the New York, Philly, Kansas City, Dallas, Richmond. We take an average of those, and it's highly correlated, not surprisingly, with the national PMI. It remained below zero. That's what it's indexed to, and suggested that the manufacturing PMI wasn't going to continue to move above 50. So again, we've been in a rolling recession in the goods sector. I'm not surprised by that. I've been thinking that it's turning into a rolling recovery. I think I still believe that, but it's taking its sweet time rolling into recovery territory. Meanwhile, the purchasing managers on the services side, the NMPMI, I'm sorry, let's do that again. When we look at the weakness in the two PMIs, services and manufacturing, we can see that a lot of the weakness was in employment, which doesn't really make much sense since the employment numbers have been pretty strong, whereas the average of the PMI's employment indicators have been kind of down below the 50 mark for several months. Meanwhile, the S&P survey global data that they survey the manufacturing and the non-manufacturing, and again, they corroborate that the manufacturing is maybe starting to recover, but not very strongly. On the other hand, they're showing some weakness in the services sector, non-manufacturing, but it's still above 50. So, the economy is still, I think, doing just fine. I'm not concerned about these numbers. How about on the inflation front? The markets have flipped from, inflation's persistent, wage inflation is troublesome. And so the Fed's not going to be cutting rates after all, to maybe there's an outside chance that they might raise rates. I think Governor Bowman discussed that last week. But the big problem in the inflation numbers is two things. It's services, and one of them is the rent component, which I'll get to in a minute. The other one is the so-called super core, and a big part of the super core services X energy. That's what the super core is. It's X energy services, excluding shelter. And so a big part of the problem is anything auto related, auto insurance, new autos, used autos, auto maintenance and repair. These are the levels, and you can see they've really taken off at double-digit paces, and they've outpaced the increase in the overall CPI. So what is this attributable to? I think some of it obviously is pandemic related. Maybe people who lived in cities, moved to the burbs, needed to get cars, and that drove things up. But, all these components related to autos have gone up. I think a big part of it is people are driving these monster trucks. This is remarkable, really, when you think about that 80.7% of motor vehicle sales are now these so-called light trucks, domestic and foreign. And that thing had been more like 50% back in 2011, 12, 13. And now we're at this remarkable percentage share of light trucks, SUVs and light trucks. And these things are expensive, and they're expensive to repair, and therefore they're expensive to insure. So how much of these auto-related price increases really reflect just outright inflation versus just a shift towards buying more expensive kind of vehicles that cost more to maintain? Meanwhile, here's the last chart I want to point out, and that is there has been a series put out by the Bureau of Labor Statistics that looks at the CPI on a similar basis as they do in Europe. And the big difference is that the Europeans don't have this cockamamie concept of owner's equivalent rent, where the BLS calculates how much would I, as an own homeowner, would have to pay myself as my own landlord. It's a crazy kind of concept. They got some statistical reasons for doing it that way, at least for adjusting consumption expenditures. I guess they figure that we're all living in our own homes, we're consuming them somehow. So in the consumption numbers, there's I guess it makes sense to have something for what we're consuming out of our houses in services. And once you do that, you have to have a price indicator in order to make all these things add up. But it is kind of a screwy concept. And you take it out and you take out the fact and you add back in that the CPI is for urban workers and it doesn't include what rural people are doing. Well, the BLS says we don't really have a way to incorporate inflation for rural people, people who live out in the sticks. But we do have urban, and we can take the owner's equivalent rent out of the urban. And they got this HICP indicator for I think it's called Harmonized Index of Consumer Prices. So that's comparable to the way the Europeans do it. And as you can see, that number is 2.4%, significantly below where the number is as the currently measured. And so we're there. We're at almost at 2%. Does the Fed really want to get back down below 2% and suddenly obsess about why they can't get it up to 2%? Anyways, inflation is moderating, is my opinion. It's moderating to 2.5% by the end of the year, and all is well with the world. So let's, on that happy note, let me look at some of the questions here. Did Max leave? I don't know. He gets bored after a while. I guess he must be listening. Okay. So the Fed at its last meeting, let me do the last thing again. The Fed at its last meeting, this is Willem. The Fed at its last meeting did engage in some monetary policy loosening. It reduced the pace of its QT. Do you consider this slower shrinkage of the Fed's balance sheet to be a significant and be desirable? Good question. Philip, I think you're more knowledgeable about these things than I am, since you had some background in running a country's monetary policy. But let me say this, that I think it's a good thing you pointed out. There was an oversight on my part, but they did do something important, and that is reduce the pace at which they're letting securities roll off their balance sheet. So that means that on a consolidated basis, if you look at the Fed combined with the Treasury, the supply of securities is somewhat diminished. Also, the Treasury has been raising more of its money in the bill market than the notes and bond market. So yeah, I think it's significant. I think we saw in August, September, October of last year that supply became a real concern, and Janet Yellen kind of heard the message and cut back on notes and bonds. And I think this is the Fed's attempt to take some of the pressure off of the long end and maybe make it reduce the likelihood that we'll get some of these note and bond auctions that suddenly will be really sloppy and create financial stress that the Fed might have to deal with. So is it desirable? Yes, I have no problems with it. Is it significant? Yes. Joe, Ed, what will Eric be doing at Yardeni Research? Be doing everything that we're all doing. Uh, there's no sort of departments, if you will. We're a team, and Eric is very original. He came up with a lot of the stories that he wrote. They weren't assigned to him, and the editors liked him and liked the stories, and they often posted them on the front page. And so he does have a background in the fixed income markets, particularly having worked at the Fed. But he's written lots of stuff relevant to the stock market. So we're all kind of jacks of all trade. I hope we're masters of some, but that expression is not a great expression, right? Jack of all trade, master of none. We try to be jacks of all trade and a master of a few things, and I think Eric will bring some Jedi master talent to the table. Okay, Matthew, when approximately do you think the Fed will first cut rates under your current forecast? Q1 2025 question mark. Yeah, you gave me my answer. In Q1 2025 is when I still think will be the case. But we're going to get a lot of chatter. This is a quiet week for economic data, but we'll get lots of chatter from Fed officials, I'm sure, kind of considering what some of the data showed at the end of last week. Kim Clark, I'm not seeing any chart. Oh, I hope you all saw charts. I hate to use Europe. This is William. I hate to use Europe as an example, but massive cars can be taxed away. What do you think? Non-starter? Yeah, in this country, trucks. Isn't there somewhere in the Bill of Rights that we're all allowed to drive these monster trucks if we so please? Yeah, I just don't see that any political will or move to outlaw or to tax these monster trucks. People who own them love them, and it is what it is. And we know that while they are increasing in popularity or have increased in popularity, people are starting to cool off to electric vehicles. I guess the longer electric vehicles are on the road, the more people are hearing about how expensive it is to replace batteries and how long it takes to get them fixed. So we'll see how that plays out. Kim again, a question for Ed. What are the stocks I see as the best bellwethers for the economy right now? I think it's always the financials. You don't really get a good economy and you don't get a good bull market if the financials are in trouble. And the financials seem to be doing pretty well, especially the large cap and the mid cap. The mid caps may still be the smaller caps may still be an issue. But I think it's become very much of a tech oriented economy. I've often said that every company now should be viewed as a tech company in the sense that they either make it or they use it. And so in that regard, technology and the technology stocks do matter quite a bit. And I would like to see more and more evidence that AI is a a technology that has immediate implications for productivity in our country. We're seeing anecdotal evidence of that, and so the more I see of that, the better I'll feel about the roaring 2020s. That AI is the technology that will drive us there. But that was never my premise. My premise was that the universe of technologies that are available can be used to increase productivity. I'll take one last question here. John, you still see the S&P 500 at 5,400 at the end of the year? Yeah, still using 5,400 at the end of this year, 6,000 end of next year, 6,500 at the end of 2026. Well, with that happy forecast, let me thank you all for tuning in again, and let's do this again next week. All the best.